My name is Zach, and this is Dividend Data. I just bought more of one of my favorite dividend growth stocks. So in this video, I'm going to do a full updated financial analysis on the stock, share why I think it has such a wide economic moat, and explain why I'm buying more now. Aside from that, I had a pretty good idea to improve this show. People often ask questions in the comments, and I really just can't get to all of them. So I thought it'd be a great idea if you guys could write in questions, and I can pick some to answer in every single episode. And that way the show becomes more community driven in a way, and more of an interaction between me and you. So to do that, I am actually revitalizing my old Patreon. Link will be in the description and pinned comment. And with that, you can ask questions every week. You get access to our Discord community where people are always talking, sharing their buys, dividends, and analysis. You'll get your name in the credits of every single video, and every month you'll get a downloadable CSV file of my dividend stock portfolio. But wait, it's not over. If you join, you'll also get 15% off merch, which is something that I've been working on recently and I plan to make more of. You see, I got this Buffett Munger 24 shirt and the back. Got the Make Dividends Great Again hat. Here, I'll get more. Some just arrived, so I'm kind of excited about it. You got a Buffett Munger 24 hat and a Buffett Munger 24 sweatshirt, which is pretty comfortable. All this stuff is actually pretty comfortable. And yes, you can get 15% off if you become a Patreon member. On top of that, you can also get 15% off of dividenddata.com by becoming a member. So that is another huge discount. Speaking of dividenddata.com, that's another thing that I'm going to be working on a lot this week. Hoping to get a new update, some more research tools out for you guys. So I might include a few clips of that in the later part of this video. But let's get to the main topic of the day. My favorite dividend growth stock that I'm buying right now. Let's roll the intro. Hello guys, it's Tuesday after market close, and I'm going to update you on my portfolio. I'll close this down. Current total value of all three of my accounts, that's the dividend account, the non-dividend account, and my Roth IRA. That total value is $227,000. I'm up 1% on the day, which is about $2.4 thousand. Total unrealized gains, $87,000. That's a 62.96% total return. And today was mostly led by Tesla being up 6.6%. That's my second largest holding. I have a 111% total gain. Altria has been rising nicely over the past few weeks, and I now have a 22% total return, which is the first time in a while I've had a big gain there. So if this dips down to low 40s again, I'll probably buy more. But not much changes in the composition of the portfolio. Starbucks was my last new addition, which I added a few weeks ago. I probably will add more if it goes down into the low 70s again. But as I mentioned earlier, I am starting to add one of my favorite dividend growth stocks more, and that's Visa. Ticker symbol V. It's my sixth largest stock overall and my fifth largest in my dividend portfolio. It's about 9% of that account. And if we go to my research page for the stock, you can see that Visa has had fantastic long-term growth, both of stock price and earnings per share. And this is one of those companies where their business model is so dominant and they have such a wide economic moat that it can often be forgotten in a lot of ways. Visa is the #1 digital payment company in the world. They have massive network effects due to being accepted everywhere globally. The business is highly scalable in that it does not take a lot of additional capital in order to add new transactions and volume to that network. And this makes it very high margin, as the incremental cost of doing another transaction and getting a fee from that is next to zero. If you want to learn more about Visa stock, I recommend you watch my full stock review video where I go over the entire history of the company, their business model, their competitive advantages, and I dive into how they actually make their money in each business segment. This podcast I Like Acquired also did a full episode on Visa, and they did a great job covering it. But today I want to focus on the stock and dive into the financials, see how it grew over time, and why I think the company will continue to grow into the future. Okay, so Visa, ticker symbol V, it's currently priced at $275 per share, with just under $9 in earnings per share last year. That's a 30 PE ratio. The current annual dividend payment is $2.08. At the current price, that's a 0.75% dividend yield. There are 2 billion shares outstanding, which at this current stock price means the market cap is $552 billion. So the company as a whole is valued at $552 billion. Revenue per share is growing at a 13.46% 10-year compound annual growth rate. The only year of negative growth in that time was 2020 during the pandemic, when transactions slowed down significantly, especially internationally across borders. And this growth rate has re-accelerated with a 16% 3-year compound annual growth rate. Net income per share is growing at a 16% 10-year compound annual growth rate. That's 18.42% over the past 3 years. Free cash flow per share is growing at a 25.7% 10-year compound annual growth rate. Again, re-accelerated with 28.47% over the past 3 years. If we look at the margins, you can see they have nearly 80% gross margins, 64% operating margins, and a 52% net margin. So for every dollar of revenue, 52.9% is pure profit. This business is a free cash flow machine. It continues to grow over time, and they're not diluting their shareholders with high stock-based compensation. In fact, they're using their high cash flows to buy back stock at a high rate. The share count's going down by about 2% a year. On top of that, they have a fast-growing dividend, which has been increasing every year since 2008. The dividend's grown at a 17.92% 10-year compound annual growth rate, 17.57% over the past 3 years. Their most recent increase was 15.56%. The increase before that was 20%. And if we look at the payout ratio, it's 19% based on free cash flow for 2023 and 21% based on net income per share for 2023. And what this says here is that Visa has incredibly high cash flows. Their dividend is very sustainable. And given the growth of free cash flow, this dividend can grow significantly while remaining this sustainable. The payout ratio has never been above 27% since 2013. Now, the catch is that this is a low yield, high growth stock. So if you're a long-term investor focused on total return like I am, then I'm okay with this. But some of you who are closer to retirement and looking for high dividend yield now, Visa may not be the best go. The most you'll get for current dividend yield when buying the stock is about 0.82%. That's as high as it gets. In the most recent quarter, they reported having $20.2 billion in cash on hand with total debt of $20.6 billion. So their net debt is basically flat. We need to keep in mind, though, this company is generating about $4.5 billion a quarter in operating cash flow with extremely low capital expenditures, only $281 million last quarter, and it's really in this $200 to $300 million range every quarter. So their most recent free cash flow is $4.2 billion just for one quarter. So with this level of cash flow coming in, their debt is not even remotely a problem. This thing prints money. If you go to the annual statement, we can get a better look of how much they're making each year. So for fiscal 2023, operating cash flow is $20.7 billion. Free cash flow is $19.7 billion. And they spend about $1 billion in capital expenditures. But what I really love about Visa's business model is how capital efficient they are. They don't need to spend a lot of money. They are not a CapEx intensive company. Since 2017, their capital expenditures have only grown from $700 million to $1 billion. But in that time, their operating cash flow grew from $9.2 billion to $20.7 billion. So they added over $10 billion in operating cash flow while only spending $300 million more a year. And the reason why this is awesome is because Visa just keeps raking in cash that's able to redistribute to investors. And that is through share repurchases and dividends. Share repurchases, they're buying back $12.1 billion of stock a year, and they're paying out $3.7 billion in dividends. They can also use this cash for acquisitions and reinvesting in the company. But what I really love about this business is that it will continue to scale so well. Visa is a digital payments company. They are just the middleman taking fees on transactions, and they have been operating with this massive tailwind as we move away from a cash society to a digital payment society. And that trend is only going to continue. And to me, it seems obvious that the future is only going to have more digital transactions. And I think the economy will just become even more dynamic. And Visa and MasterCard are the best positioned to win from this. And if you do want to learn more about the company, I really recommend watching my prior video on Visa stock, where I go more into the business model, because a lot of people think Visa and MasterCard and they think credit cards, but they don't actually bear any of the credit risk themselves as an entity. That is all through third-party financial institutions that they issue cards to. Visa operates the network. They are a digital payment network. They process transactions, authorize it, clear it, do security, value-added services, etc. This is not a credit card company. Now, the other concern many of you have is, hey, Zach, Visa stock, it's kind of close to its all-time high. It just reached $290 in March. Is now really the best time to buy? Shouldn't you be waiting for it to crash? Now, as many of you know, I would love to buy the stock at lower prices. I'm all about it. And some of you may say, Zach, there's a 30p ratio on Visa. Isn't that a little high? And my response would be, I would love for it to be cheaper. But we also have to put this in the context of their growth rate and their high margin, wide moat business. I mean, if we have free cash flow growing at this kind of rate, a 30p ratio is not crazy. This growth is much higher than Microsoft's, and Microsoft's trading at a 37p ratio. Apple's trading at a 30p ratio, and Apple hasn't been growing at all recently, although long-term they've had fantastic growth. I mean, Costco's trading at a damn near 50p ratio. That's crazy. And their business model is fantastic and has an extremely wide moat, growing subscription revenue from those memberships. Their business is awesome, but Visa's business is also awesome. So just because something is trading near its all-time high price does not mean it's a bad idea to invest in it. You really have to think about how that business is going to evolve over time. Are the earnings of Visa stock going to continue to increase at this rate? So in April, they reported $2.51 for earnings per share. Is that not going to be $3 soon, $3.50 soon? $4 in like 5 years? And if that's the case, does it really matter if I bought in at 270 or 280 or 290 or 250? Because if that's the case, then that stock price is going to be a hell of a lot higher then. So I started buying Visa again. I just bought 2 shares at a cost per share of $275.70. I'm planning to buy more at this price and below. And what I really want you guys in the comments, comment this at me. Every time that I have my eye on a different stock, say, Zach, would you rather own Visa at this price or the other stock? And I have a feeling a lot of the time, my answer would just be Visa. And that is really the game of opportunity cost you should be thinking about when investing, because you don't have to invest in everything. You're picking and choosing. So the game is, would I rather own Visa or this, Visa or that, Visa or that? So what should we expect over the next few months? I am expecting Visa to climb up this chart. I want Visa to be up here with Microsoft eventually, and I think I'll get it there. And I think Visa and Microsoft could be that 1-2 punch that really turns this dividend growth portfolio into a high total return thing that could actually beat the market, and with high dividend growth underneath it, high sustainable dividend growth underneath it. So anyway, that's just my thoughts on that. I'll get back to you for future market updates later this week. And of course, if there's any news I find interesting and want to talk to you guys about. See you later. All right, guys, today is Wednesday after market close, and I'm going to give you an update on my portfolio's performance today, plus go over Nvidia stock earnings, which just released after the bell. I'll explain all the highlights from that and what I think about the stock. But first, let's get to my portfolio. Across all my accounts, the total value is $225,000. That's down 0.72% on the day. Have a 61.81% total return. And most of this was led by Tesla, which is my second largest stock, down 3.48%. This is after being up 6% yesterday. So just a little volatility, as we say. Dividend portfolio was only down 0.22% for the day. Visa stock fell a little bit, but not enough to hit one of my buys again. I have another buy at $274 and I think 92 cents about. So I'm hoping to get more Visa buys throughout the week. And as I mentioned earlier, Visa is one of the top stocks I'm targeting. But as I mentioned with Nvidia, we got some interesting news coming in. They reported earnings, and one of the things they announced is a 150% dividend increase. And here you can see the stock and the fantastic earnings growth they've had really since the AI boom in fall 2022. It's insane, to be honest, the amount of demand that they've captured. But Nvidia's dividend is extremely small and has not grown since 2018. So this is just a very minor increase at best, to be honest. That prior dividend was 1.4% of their free cash flow for 2024. But yeah, I'm going to break down Nvidia's earnings report. Some of it's already starting to trickle into dividenddata.com. You see non-GAAP earnings per share is up. They reported $6.12 for the quarter. That's a continued just straight line growth. And the real question when we're analyzing Nvidia stock is whether this earnings increase is sustainable and actually going to be there over the long term. Or in 2025 or 2026, is it going to dip down to like half this level? All right, so Nvidia reported earnings for first quarter fiscal 2025. Nvidia is one of those weird companies where they're a little ahead in their fiscal calendar. And here are the highlights. They recorded record quarterly revenue of $26 billion, which is up 18% from Q4 and up 262% from 1 year ago. So Q1 2024, that's a 262% year-over-year growth. They had record quarterly data center revenue of $22.6 billion, up 23% from Q4 and up 427% from a year ago. So all of this growth pretty much has been in the data center. That's the cash cow. because all these hyperscale cloud companies, whether it's Google Cloud, AWS, Microsoft Azure, they're all buying up Nvidia's GPUs, which they probably shouldn't be called GPUs anymore. But that's the interesting thing with Nvidia, is that a lot of this buying power and demand is coming from the other large tech giants. And of course, tech startups, which have raised lots of money from venture capital. And there's even governments throwing money into AI so that they have data centers. So there has been a massive surge in AI demand, and all of it is going to Nvidia. The stock price is up 6% after hours to $1,007. They just cracked $1,000. And they just announced a 10-for-1 forward stock split effective June 7th, 2024. Now, a stock split does not impact the valuation of a stock at all. All it means is that they're dividing the company up into more shares. So in order to have what's equivalent to 1 share today, you would need 10 shares then. And companies like to do this when their stock becomes a high price a lot of the time because it allows a cheaper entry point. And this is good for retail investors and traders, although it's becoming less relevant as most brokerages allow fractional shares these days. And then they raised the quarterly cash dividend 150% to what will be 1 cent per share on a post-split basis. So in the past year, gross margin has grown from 64.6% to 78.4%. That's fantastic. Operating income is up 690% from $2.14 billion to $16.9 billion. That's in just 1 quarter. GAAP EPS came in at $5.98, which is up from 82 cents in the year prior quarter. With non-GAAP EPS, it came in at $6.12, which is up from $1.09 in the prior year quarter, a 461% increase. This kind of growth in 1 year is insane. You rarely will see this in this large of a public company. They also provided outlook for the second quarter of fiscal 2025. They're expecting revenue to be $28 billion plus or minus 2%. So this is a slowing in the rate of growth even from Q4 to Q1. GAAP and non-GAAP gross margins are expected to be 74.8% and 75.5% respectively. You really have to give credit to Nvidia and their entire team in that they have been forecasting this AI trend for about a decade at this point, and their GPUs were best positioned in the market to take advantage of it. So they had this huge first mover advantage, and that is this massive increase. It took a while, but boom, it happened. But the question you have to think about as an investor moving forward, if you plan to hold the stock over a multi-year or decade time horizon, to justify this current valuation, you have to believe that Nvidia's earnings are going to stay at this level and continue to grow over the next few years. If we take the most recent quarter of EPS and we just forecast that as the full year for 2024, so we're expecting $24.48 in earnings per share. And if we take the current stock price of $1,007 and we divide that by that forward-looking earnings per share, then the company is trading at a forward PE of 41.1. So this doesn't seem that insane of a valuation, but it's all about what that future growth is going to be and whether or not they even sustain these earnings over the next 2 years. And last year, I made a full Nvidia stock review video, and it's titled, "Is Nvidia Stock Priced to Fail?" Now, since I made that video, the stock is up 100%. So I was clearly wrong in the short term, although I said in the video that I likely was going to be wrong in the short term. But in this video, I go through the entire thesis around Nvidia. I explain their history and how they got into GPUs and gaming. I explain the deep learning breakthrough, which really set the stakes for this entire AI moment. I go through all their different business segments and how they make money. I do a stock analysis. I do the bull case, the bear case. So if you want my full thoughts on this company, you should probably watch this video. And you'll learn a lot too. I learned a lot just making the video, especially around deep learning and all this stuff. I knew some of it because I have a computer science background, but it's still very interesting. And this whole rise in Nvidia stock is something that I'll reflect on and is going to be in my mind as an investor going forward. I didn't buy the stock because I was unsure of what the long-term demand around this recent surge in AI related chips was going to be. Because for it to be sustainable, there would need to be economic value created for all of these companies that are buying it, or else they will not continue to buy the chips. However, it was extremely obvious that in a 1 to 2 year time period, that demand was going to stay and only actually continue to grow. So it makes me think that I should be more open to these short-term trades in the future as well. Because Nvidia, in many ways, it doesn't necessarily fit my long-term investing thesis right now, but it was so obvious to me in early 2023 that I should have been buying this probably as a trade. So just a little food for thought as we continue to learn as investors and everything. All right, guys, so I'll check back in with you if I have future updates later this week. See you then. All right. Hello, guys. Checking back in on Thursday after market close. We're down 1.57% on all my accounts today. That's a pretty big dip. So from this week so far, from when I recorded Tuesday to Thursday, we've gone from $227,000 total value to just under $223,000. And this is the reality of investing. There's lots of day-to-day volatility, but you got to stay focused on the long term and keep your strategy in line. Tesla down another 3.5% today, so it completely lost that 6.6% gain on Tuesday. Disney down 2.29%, so that's interesting. $100 is a pretty good entry price in my opinion if you don't own the stock. Starbucks down 3% today, $78. Again, low 70s I'd consider adding, but as I mentioned earlier in this video, I am really focused on adding Visa stock and increasing my position there. And given that the market went down today, I just bought 2 more shares at a cost per share of $274.35. And now it's about equal to Broadcom in my portfolio, about to jump in that number 4 spot. And like I said, I'm going to keep dollar cost averaging into this position, buy on dips. I want to get it above Exxon, then above Altria, and have it up there with Microsoft as 2 of my core holdings in this account. There was a lot of movement in the market today. Intel down 4.26%, Globe Life down 5.9%. But the biggest of all was Nvidia up 9.32% after earnings. So now they're at $1,037 in stock price. Let's check that out. The company is now valued at nearly $2.6 trillion. Earnings growth has been insane. Free cash flow growth exploding insane. $6.08 per share in the latest quarter. But again, I'm going to reemphasize my fear with Nvidia in that I think a lot of this demand may be cyclical and it won't necessarily be at this high of a level in a couple years. It really comes down to what kind of economic value these big tech companies are getting from buying these chips to put in their data centers. And yes, they'll replace them generationally, but if they don't see a reason to invest billions of dollars continually into this, then they'll just stop buying it and the earnings will completely drop off. So it's a very interesting dynamic and I'm just watching it play out, but clearly the demand is still there right now and slowly growing from this base. Although it is important to note that the growth rate is decelerating. The latest quarter did show a slight deceleration. Still growing very fast though. So that's my accounts for this week. And again, I'll close out this episode by recommending that you join the Patreon, which will give you a bunch of perks I mentioned at the beginning of the video, plus asking questions, which will be featured in every single weekly episode here on YouTube. You can also get your name in the end screen, which I'll play soon, and 15% off merch and dividenddata.com. So I think it's a good deal. There's a 7-day free trial. Feel free to try it out. You also get access to our Discord and the ability to download my dividend stock portfolio every month. Try it out. Thanks for watching.